All right, well, greetings, everybody. Welcome, investors. Welcome to our special educational session before our April 26th roundtable session. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing. I'm joined here by Ken Kavula, and Ken and I will be doing the first half of the presentation. Then we'll go into a traditional roundtable, and we have Candace Baker of St. Louis and Ann Manning of Houston with us for the rest of the show. So we're going to be with you for the next couple of hours. Good evening, Ken. How are you?
I'm doing real well tonight, Mark. It's been a terribly ugly weather day up here, but a nice day to be home. We got to sleep in our own bed last night after traveling for about 9 days, so it was nice.
Good stuff. And yes, those of you that have asked, that is probably from opening day at Busch Stadium in St. Louis, and those are Clydesdales and wonderful workhorses. That's the subject of our first 45 minutes or so together here this evening. And we've been talking a little bit for the last few weeks about the medium-sized companies in our portfolios and how they are something of almost a flyover type thing. We spend an awful lot of time seeking, our best small companies and, of course, the large companies that dominate portfolios. And the ones in the middle actually have some fascinating characteristics and contributions to investing. So that's what we're going to touch on here for the first few minutes here tonight. So I'm going to go ahead and kick us off, Ken, with our standard disclaimer. This applies to the entire program tonight. No investment recommendation is intended. This is about education and specifically a demonstration of philosophies, methods, and techniques that are 8 decades in the making with the modern investment club movement. So consider everything here to be for illustration and demonstration. They are our opinions about this stuff. We think there are tremendous lessons that have been learned and success achieved by many of us as individual investors and clubs in the modern investment club movement. So please do your own homework before making any decision. And if we own something we're talking about, we'll try to remember to point that out. If you have, if you'd like to be added to the roundtable reminder, we do a monthly program. That's the second half of tonight's show. Send an email to nkavula1@comcast.net. And if you'd like copies of the slides, my email address is there, markr@manifestinvesting.com. Any further comments, Ken?
No, Natalie is eager. She's been getting a lot of requests ever since we started advertising this event in St. Louis. So we hope we've added a fair number of St. Louis folks to our reminder list. And that reminder goes out once a month. That's the only thing we do with those names. And we just let you know that the roundtable is coming up, the time and the date, and give you a chance to register for it.
Okay, well, let's go ahead and proceed with a little bit of history. I actually think that, and Candace, I want to say thanks to you and Fred and Ray and the whole team down there in St. Louis. We've been doing this for a while, and I consider St. Louis to kind of be the birthplace or the foundation of what ultimately became a series of classes that we talk about success or successful investing. And this one goes back to April 2009. This was a full day program, and we just had a blast. I just remember sitting in the parking lot after the session and talking to people after the session, and that's kind of where this all kind of started. And we've been back a number of times. I put together just a few slides just to make the point that we've been doing this in St. Louis for a while. We came back a couple years later. Both Ken and I were here for this one. Focusing in on the beginning aspects and the fundamentals, getting started, what's it all about. Spent a little bit of time talking about Denzel Washington and explain it to me like I'm a 5th grader. And that was a fun session. Ken, you probably remember that one.
I do, Mark. I missed the first one. I had a previous engagement, but I've always enjoyed the St. Louis audiences, and I look forward to this evening as well.
And then part 3 was just a few years later, again, talking about this notion of super investors. In fact, later on in the program, we're going to talk about one of the super investment clubs from St. Louis. They have the mutual friends down there, but they also have the broad assets. We're going to talk about them for a minute as being super investors. And again, just extracting the lessons that we can learn from watching people who are successful at this. And that's what this entire session was basically built around. So that was the third one. Then we were going to do the fourth one last year and then this year. And again, COVID got in the way. So it really was kind of the inspiration behind these successful investing conferences. We've done 4 of them now, about 6 months apart. And the one that we did back in May 2020, just wanted to point out, and I'm pandering to the St. Louis audience here now, that one of my panel selections was AB InBev. It's up by 24.6. Now, I did do some field research on that one and found it to be a good product, and it's worked out pretty well so far, up 24.6% annualized since then. But yeah, we've had a number of successful investing conferences, including the panel sessions, which are very popular, and had a pretty good time with that. Like I said, we've done it 4 times. There have been 4 conferences. That is why you might want to take a look at the type of selections we made. The selections we made back in May 2020 just knocked it out of the park. And it was a great time because you may recall that was just after the start of the COVID-centered recession. So I know that, Ken, you've enjoyed them also, enjoyed the sessions.
Well, putting them together was something. It's a whole different idea about putting these kind of conferences together rather than putting something face to face together. And in a way, it's very gratifying to do not nearly as much work as a face-to-face event, and yet to pull audiences 2 and 3 times the size of the convention audiences. That rate of return, beating the market by over 5 points, is certainly something to be admired. And not all of our picks were right up there with that kind of return, but the average was. And I guess that's what you do when you're trying to put a portfolio together, isn't it?
The big portfolio, yeah. Some of ours from the last session are still definitely a work in progress. So we continue to be hopeful. Then I also want to go back to a national convention in St. Louis. Back, I don't remember the exact year of this one. Was it 2010?
Oh, it's dated 2010 on the picture, Mark.
Okay, and notice the picture. It's from the session that Ken and I like to do. 2 guys talk stock, and David Carson from the St. Louis Post-Dispatch takes the picture, and it says right there, Mark Robertson, not pictured. Not that I bring this up very often, but I'm a little bitter. It's
Don't let him fool you, folks. He brings it up every time he gets a chance. So.
But for those of you that aren't aware, the Pulitzer Prize, it is named after Joseph Pulitzer, who was involved in the publishing business in St. Louis. And I just love that quote. Again, it comes down to the stock selection guide methodology and philosophy of making it so people can see it. Some of us are very visual. Some people don't like numbers so much as pictures, and it all kind of comes together. And well, I'll let you tell the story, Ken. I mean, it was so much fun with this photographer in the room. He's sitting at the back as the class is going by, and I'll let Ken describe what he presented, talked with us afterwards about.
Well, we never quite know where a 2 guys session is going to end up. It goes all over the place, and we listen carefully to the things our audience asks us to talk about, and we're prepared to move in lots of different directions. But at one point during this particular session, we were looking at visual analysis of a number of different companies that people were shouting out tickers from in the audience. And some of the visual analysis were really pretty, up straight and parallel, as the folks in mid-Michigan like to say. And we were getting oohs and ahs and applause from the audience. And then somebody would call out a clunker with no earnings line, or with an earnings line that looked like a roller coaster from Cedar Point. And they'd be guffaws, and there'd be all kinds of people kind of mock booing and telling us that was not the kind of stock we're looking for. And we really threw the reporter for kind of a loop. And when the whole session finished and he came up to talk to the two of us, he wanted to know what kind of cult this was, that we could take the emotions of the audience and take them from applause to booing and everything in between just by showing pictures on the screen. So you know what we're talking about. We were doing nothing more than looking at the visual analysis of the SSG and appreciating a really great growth company and the way that it looked on the graph. That's all.
Yeah, it was good fun, and I actually have forgiven David Carson a long time ago. He's actually one of the most respected photographers in the nation for newspapers and stuff. So pretty cool. All right. Well, Ken, I'll let you take us away here with just a reminder of, what these 8 decades have been about.
Well, I've seen these principles written and talked about in so many different ways, but they all come down to just a very few good, solid, basic ideas. Invest regularly, diversify, and diversify prudently, which to us means not only by sector and industry, but also by size of company. Stay invested, have a lot of patience. The better investing methodology demands that you be patient and, more importantly, that you be disciplined. It calls for you to sell occasionally, and that's part of the discipline, just like buying is. But we're not selling willy-nilly. We're selling after we have good reasons to sell a company. And most of all, it focuses on the best companies. We can find instances of George Nicholson, and that's him up in the upper right-hand corner there. We can find instances many times of Mr. Nicholson writing, buy the best. Always look at an industry with an eye towards buying the best, or at least the second best growth company in that particular industry. The other two people below Mr. Nicholson are Mr. Tom O'Hara, who was the longtime CEO of Better Investing, and beneath that is Ken Janke, who was the longtime executive director of the association. So together, those three men are the shoulders on which we stand today, trying to move forward with those particular principles that come to us for they're 70 years old. We're celebrating our 70th anniversary at the Dallas convention. We might be celebrating it a year or two late because of the pandemic, but we're celebrating 70 years of patience and discipline, and most importantly, of well-crafted, high-performing portfolios.
Absolutely. So let's go ahead and keep rolling. All right, let's go ahead and tackle a little bit of a misunderstanding that we often encounter when we're talking to investors. And I know this is one of Ken's favorite areas to try to reinforce and demystify a little bit. And a lot of times we'll hear about people screening for 15% growth. And what I wanted to do is just kind of put in context. What I did is I took the companies that are in the Value Line Investment Survey, the book, and just basically characterized, well, where do they actually fall when you talk about their sales growth forecast? And I think you can see pretty easily that's kind of a flattened bell curve on one side. Somewhere around the middle of that chart is in that 8%-ish range. So right around 8%. So to really find a company, especially in those larger, more established companies, it's pretty tough to find those 15% growers. And I know this is one of your pet peeves, Ken, so go ahead and mount the soapbox.
Well, folks, Mr. Nicholson never suggested that each company should grow 15%. He said you wanted 15% growth in your entire portfolio, and that was just a shorthand way of him telling us he thought we could beat the market by 5 points. Over history, Mr. Nicholson knew that the market had returned 10 points, give or take a point, for lots and lots of years. That number, by the way, is still true today. The market on average does return somewhere around 10% a year on average, and that depends a great deal on how you're going to measure the market. There's a lot of different ways to measure it, but if the market's returning on average 10, Nicholson said we could beat it by 5, hence the 15% was growth. was born. He never started out with the idea that you could double your money in 5 years. That, in fact, was a marketing campaign out of the 70s that Better Investing used to draw attention to its methods. But it wasn't the prime reason that 15 was chosen. Nicholson said, I think we can beat by 5, and if you try to beat by more than 10, you're being greedy, and it's almost impossible to do. So he kind of defined a range that he'd like to see investment clubs operate in, and that would be somewhere 5 to 10 points above the market performance, whatever the market was doing in that particular year.
So let's carry the discussion just a little bit further. And this is where you get into again, making the distinction between that 15% number, which did refer to the total return on the portfolio, and breaking it down into the components now. And this is actually a question from an investment club that we answered in one of those successful investing conferences, where we fielded a bunch of questions from investment clubs. And they basically were suggesting that we don't seem to pay a whole lot of attention to company size, and we do. And in fact, the part of the message of tonight's session is that the recommendation is for us to buy and maintain a portfolio of medium-sized companies that accounts for almost half the portfolio. And, we define a medium-sized company as a company growing between 7 and 12% at the top line growth. And this is just to illustrate how easily it is to become confused by it. The bar chart on the left is from Forbes, where they basically ask the question, how do you measure a company's size? And you can see there's all kinds of different answers. Wall Street uses market value or market cap most commonly. Better Investing does center around, at least part of the time, on sales. And you can just see there's a whole bunch of answers, and our answer is none of the above. It's the sales growth forecast that makes the most sense. And that's coming straight out of that book on the right. The NEIC Investor's Manual was largely written by George Nicholson, edited by Tom O'Hara. There were some contributions from Ralph Seeger in the text, but in that book, it makes the point. The 15% is about the total portfolio, and that was to be achieved with an overall sales growth forecast of 10 to 12%. And so again, you stack up the companies in your portfolio to reach that threshold. Some of the companies in your portfolio are going to be larger companies growing at like 5 or 6%. So for all of those, you have to have smaller companies to offset it. But again, the nuts and bolts of the portfolio is very often going to be those one right down the middle, those medium-sized companies growing between 7 and 12% that really carry a lot of the load. Your thoughts, Ken?
I agree, 150%, Mark, if I can use a number that doesn't make any sense itself. The portfolio mixture of these small, medium, and large was something that I discovered when I first discovered Better Investing. And I was taken at that point by the amount of time that wasn't spent on looking at small and medium-sized companies. The Better Investing that I first became acquainted with was spending an awful lot of time focusing on large dividend-paying companies. And when you read the materials that Better Investing had available, you found that that was only a piece of the pie. That the small companies contributed something very, very unique to the portfolio, and that was sales growth, which you needed to make these lofty goals of beating the market by 5 points. And then, like you call them, the flyover companies, the medium-sized workhorses of the portfolio, and those are the ones that you need to have in abundance to be able to come even close to that beat the market number. So all in all, I think that the diversification, we've done a nice job in the last 30, 35 years in Better Investing about bringing the small caps and the mid caps on board now. And here I am calling them capitalized. It's actually small companies and medium-sized companies as defined by sales growth.
Mm-hmm. And for more on that subject, that link at the bottom is a public link. And if you do have trouble getting to it, send me a note and we'll fix that right away. So again, here, just to reiterate the stuff we've been talking about, Again, these workhorses, the ones right down the middle, we spend a lot of time talking about, especially a lot of those up, straight, and parallel companies are blue chip companies, stalwarts that are large and mature, and with sales growth forecasts is in that 3 to 7% range. By the way, 3% is the point at which Mr. Nicholson said he began to lose interest in a company. Perhaps the sales growth is just not robust enough. So that's where that 3 comes from, and then 7 being the upper limit of those larger companies. And the smaller ones are 12% and above. Ken and I spend a lot of time talking about those, and we do find that we focus on both ends of that spectrum. Yet down the middle, 50% of the portfolio really should be, as it says in that last statement. And we really don't spend a commensurate amount of time talking about those companies.
It's also surprising, Mark, what kind of companies end up on that list, especially when you're using the definition of sales growth to set this small, medium, and large. I sometimes wish, instead of calling it those 3 things, we just talked about slower growing, faster growing, and average growing, or just growing companies, because that's really what we're talking about. Your intuition fails you sometimes until you look very closely at the sales growth forecasts and tell yourself, I don't care what I think about this company, it's acting just like the other medium-sized companies that I have in my portfolio.
Yeah, the cap thing is a problem. I mean, when we talk about this every year with the small caps are not necessarily small companies. There's a lot of companies that are classified as small cap, and they're small in terms of the value of the company because they're damaged goods. And they're not just simply faster growing companies that are on their way up. And again, that distinction is an important one, and it's one that Wall Street gets wrong all the time. And it's part of some of the problems with Wall Street. This graph actually captures it a little bit. We talked about this one. This has been kind of a popular slide. So Ken, would you like to walk us through this one? This is
Well,
kind of a stunner.
we basically just, and again, you can't get statistics as often as you'd like based on the kind of definition we use for growth. So we're using capitalization as a proxy for growth. And even when you use capitalization, even though we know that there are companies in these capitalization definitions that probably don't have the growth to match the name that we're talking about, we notice that the mid caps, the medium-sized companies, tend to outdo the largest of the group, and that would be the S&P 500. The S&P 500, the blue line, is essentially made up of large, more slowly growing companies, and that's what you would expect, and you would expect the growth, the appreciation to match the growth, and it's slower. In a lot of cases, that red line, that's the small companies, will, kind of trade places with the orange line. They both grow fairly robustly when you're talking about capitalization. But what's interesting to me is the performance at the top of the chart at the bottom there, where you look at the value line arithmetic average, which is made up of a selection of small, medium, and large companies. It's made up of a lot of the companies that Mark has circled there, but you put them all together and you go over to the right-hand side and you notice that it seems to perform better than almost anything else, better than the total market, that's the Wilshire 5000, and better than any of the segments of the market, whether it be small, medium, or large. Again, the mixture of sizes of companies tends to keep your portfolio growing at its maximum ability, and that's what you should be looking for when you put a portfolio together. Recommendations, again, half of your companies in that mid-cap range, and let's drop the cap and just talk about medium-sized range, and that's growth of 7 to 12%.
Yeah, and in fact, this afternoon we were talking about this a little bit, and I'm reminded of a specific St. Louis moment. You're going to remember this one, Ken. We're sitting in the hospitality room with Sam Stovall from Standard & Poor's, and we were talking about how we could actually point to a number of investment clubs that had basically sidestepped recession and tough times. And you can actually see some evidence of that here. We talked this afternoon a little bit about, notice that the blue line between this point here and this point here, that's what is known as the lost decade in the S&P 500. It basically went down in what you're looking at here. And during that same time frame, we actually saw decent gains in the medium and smaller sized companies over that same time frame. And then over the last 10 years, from 2010 till recently, the S&P 500 has been red hot. Our concern is if that gets overheated too much, we could have another one of these flat spots, with the S&P 500. And that's all the more reason to have that appropriate mix of medium and small size companies. So do you remember wrestling with this one over adult beverages with Sam Stovall?
Oh, a number of times, yeah, Mark. One of our friends in the audience, Matt Spielman from Houston, makes a humorous point. He says that if you have a 50-year-old small cap company, it's probably not a small company by our definition. So when you have lots of history attached to a small cap, it's probably not growing at the kind of rates that we would suggest a small company needs to grow at.
Well, that's a natural segue. So Matt gets a star because you get a great small company. The point of the story is your work is never done here. Because a good small company is going to become a medium sized and a large company if it's successful enough. So we'll talk about that a little bit. All right, here's a quick look at finding current medium-sized companies by that 7 to 12% threshold that we're talking about. I'm using Manifest Investing here, the stock screener, and what I'm doing is basically looking for companies that fit that growth rate range of 7 to 12%. And then all I did was throw 80 and above as an excellent company. 80 for financial strength would be basically an A or better in financial strength, if you want to think of it that way. And the 80 for EPS stability basically says you're dealing with a company that has fairly consistent, reliable earnings. And that's a pretty good chart to go shopping. What jumps out at you, sir?
Well, and again, as you read down that list, I think some of you would be surprised to see a Visa, for example, on that list. My immediate thought about Visa is that it's a very, very large company, but because of the kind of growth that it exhibits, really, it's a medium-sized company. It's a good, solid, average grower, and that puts it in that 7 to 12% range. It's not growing slowly enough to be considered a large company. There's another couple ones on that list that might surprise you. Go about halfway down, and you'll find Microsoft on that list. Now, I know that they're getting beat up real badly today after the market closed because of their earnings report, but earnings reports happen very frequently, and strange things happen around earnings reports. And a lot of times, whatever happens around earnings, you look at it a month later and you can't even tell what was going on. So I have faith in some of these companies that the growth is going to continue. And I have faith that if we stick to our discipline, we're going to be able to put portfolios together that are going to take advantage of that kind of growth.
A lot of these companies are in community portfolios for sure. And again, the other point to be made is Visa, it might seem like a pretty large company, but that is an awfully big swimming pool, an awfully big pond that they play in. So that's another way to think about it. I just ran one more really quick one with 90s instead of 80s, just to show you the type of companies that make this type of list. There's a number of long-term community favorites. MasterCard makes this one. Fastenal, Middleby, Apple even makes this one. So you can find these are very strong up, straight, and parallel type characteristics for a group of companies that fit the medium-sized definition by growth. So good, clean fun to go shopping, especially those ones up at
Even
the top.
even in the middle of that list, Nike, Mark, that's a kind of a surprise to me. I would not have guessed that Nike's growth is as robust as it really is.
Mm-hmm. That's a good study for an opportunity to own it at the right price. Definitely.
Absolutely.
All right, so we'll spend the rest of our time talking about some specific examples, and this is where Matt Spielman's nudge comes in. I was a member of the Mutual Club of Detroit for several years, and they had actually bought O'Reilly Automotive back in the 1970s. And a good Missouri company, no stranger to most of us here. And you can see in those early days, I mean, I would have joined that club back in this time frame, so that they already had probably almost a couple decades of experience with O'Reilly at that point. Back in that time frame, it was growing pretty rapidly. It satisfied the small company definition of 20%, approximately 20% for a growth rate, and it matured over time to where it's basically firmly ensconced in the medium range during this point. I'm kind of intrigued by the little bit of an uptick here, also, Ken. But what you're looking at is basically a very long-term SSG. Stock selection guide, because that's the sales up at the top, the price down the middle. Very rewarding for somebody who has owned it for quite a while. The Mutual Club owned it for at least 3 decades at that point in time. So you can see a little fun fact there. 2000 invested in O'Reilly back in 1994 would have been worth almost $500,000 30 years later. Annualized total return of 22%. Those are the earnings down at the bottom, and you can see they've been handsomely exponential. So that's my first memory. And again, I'm reminded of I never was in a meeting with George Nicholson. I came after him, but Nicholson came into the Mutual Club meetings and basically said, what small and medium-sized companies are we pursuing on tonight's agenda? Tom O'Hara continued that tradition, and I definitely heard that.
Just a note before you get off those 3 charts, Mark, I like the analysis about that might look like an SSG. And I just want to make the point that the first 2 graphs are displayed on logarithmic paper, which makes consistent growth look like a straight line. And the last one is displayed on traditional graph paper, which makes consistent growth display as a piece of a parabola, as we're seeing there. So if we were to put that on logarithmic paper, we'd probably see 3 straight lines, and we'd see that up, straight, and parallel concept that we'd like to.
All right, I'll fix it for the next time around, Ken. You caught me. You caught me.
We're looking now at something that I started to do when we put this concept together for this class. I wanted to kind of look at my own portfolios that I'm involved in and that are kind of out in the public there. And I wanted to see how closely I was following the concept of a large percentage devoted to mid-cap stocks. I remembered that my accounting software would allow me not only to look at the size of the company, but would allow me to look at the annualized internal rate of return. And that's the only way to really figure out how a stock is doing year over year over year. It's a little bit more complicated than just taking the end value and subtracting the beginning value and ending up with a return value. IRR is a much better measure of it. So I went to the Mid-Michigan Model Club, which has been around for about 14 or 15 years now. And I started looking at the stocks that have large annualized internal rates of return. And those that I greened out near the top of the list there end up being the stocks that are medium-sized growth, growing between 7 and 12%. Credit Acceptance doesn't fit that category, neither does Checkpoint Software, but the other 7 companies up there are showing pretty decent kind of return, and that's the kind of return you want out of a workhorse. I especially appreciate the return, and I'll admit I was flabbergasted to see the return coming from O'Reilly Automotive. And look at the date on that one, folks. That dates back to 2004. for that holding. So 2004 to the present time, that's almost 18 years now. And we're looking at a 44% annualized rate of return. You don't have to go after fancy high-tech companies to get outstanding returns from pretty easily understood kinds of companies that just very quietly keep growing at 7 to 12% and keep themselves right in the place where you'd like it to be. I would do anything to have 8 or 10 of those companies in my portfolio. Right behind that Monster Beverage, that's no slouch either, and that's coming from 2008 to the present time. That's 14 years at 38% IRR. I really think anything around 8, 9, 10% IRR is doing its job in the portfolio. So there's a kind of a list of companies that have been doing their job for a relatively decent period of time. In fact, if you look at the annualized internal rate of return numbers as you go all the way down to the bottom of the list, kind of compare it to the dates, you'll find that the worst returns are coming from some of our newest holdings. And I think you might expect that to be happening, especially when you consider what's been going on for the last 2.5, 3.5 months in the current market.
Well, we need to move on.
Just be patient. Just patience. That's all it takes.
Be patient. I think you need to have Fred Tunnies actually deliver a thank you to O'Reilly next time he sees him.
Okay. Here's from the B.I. Baker Model Club, another model club that I belong to. And there's a company at the top of that list, almost 38% IRR. And I doubt if many of you even know Mastech and what it does. MTZ is the ticker. I'm going to leave that as an Easter egg. Go and check it out. Take a look at the SSG. Take a look at what it does. And I think you'll be pleasantly surprised. I know that since 2020, we've been pleasantly surprised at the return from this stock. This is a much newer club. This club's only about 8.5, 9 years old. And one of our oldest holding is doing a nice job of holding its own. And that's Dollar General down there in the 4th spot. At 22% plus IRR, and we've been holding that one for it's going on 8 years now, I guess. So you have some really good things happening. Look at the difference between Google in this portfolio and Google in the portfolio previous. When you buy a stock, makes a whole heck of a lot of difference as to what the internal rate of return is going to be. The Google in the Mid-Michigan Model Club has only been held for less than a year. The Google in this club's been held for going on 8 years now. And you see we're going from negative returns to good, solid, positive returns in those two sets of numbers. One more set of numbers just to show you some names. And this comes from my own personal investment club. I found that we were holding a few more stocks than the model clubs held. But again, I could find 5 out of the top 9 or 10 stocks in the portfolio that were good, solid, medium-sized companies. And when I look at United Health Group, UNH, which is only a 2-year holding, a little bit more than 2 years at 45% internal rate of return, I could say to myself, somebody in that club did a really nice job of presenting an SSG at a very opportune moment. Pair that with United Forest Products, even after the market declines since January, we're still looking at a 35% internal rate of return for just over a year. And there's a 2-year return on Apple. There's a 12-year return on Apple. And that, of course, is the stock that's keeping this portfolio moving ahead, chugging right ahead. That plus, of course, our AbbVie holding, which we're really excited about AbbVie, even though we have never been able to buy a whole lot more of it. We bought it twice, and then it moved right out of the buy zone. And we are very disciplined, so we didn't go chasing it. But the little bit that we have, the 100 shares that we have, are certainly performing for us. So you can find these stocks. They're good, solid names. And there's nothing fancy going on here. It just takes a little bit of time, a little bit of diligence, and you can come up with these SSGs. And then don't force your SSGs, folks. Make sure that they're reasonable, make sure they're on the slightly conservative side, and then wait. Wait for them to demonstrate that it's time to buy the stock. Listen to what your stock selection guide is saying to you.
Yeah, and the images down at the bottom are just a reminder that this is an actual former Groundhog Group champion from a few years ago. I think it was 2010, if memory serves me correctly. And that's a before and after picture with the wolves from the center. And then after winning the contest, you could see they're on the beaches of Cancun or something.
I didn't realize that's where you were going with the graphics, Mark. Okay.
We'll hear more about them when we talk about broad assets. All right. I want to close with this slide. And again, it's a reminder about the power of these medium-sized companies, these workhorses that can be such a wonderful thing. I actually wrote this when my first grandson was born just a few years ago. I was actually at the Capital Area chapter in Lansing, Michigan, the night before he was born, and wrote this the next day. I would invite you to go and take a look at it at Manifest Investing. But again, this notion of starting early and investing in these type of companies and how powerful it can be. The reason I brought this is because I remember Biomet so well. I mean, they're now part of Zimmer, but my mom and dad, that's the great-grandfather and great-grandmother that are mentioned here, they were actually in Springfield, Illinois for one of those investor fairs back in the heydays. And I came down to breakfast, and mom and dad were sitting with the Biomet investor relations person having breakfast. And she made the point to them that $2,000 invested in Biomet as recently as 1982, and this would have been late 1990s, was worth $1 million. And my dad sat there and he says, I had just left the railroad. I had that new job at the golf course, and I had that IRA. He was away from the railroad retirement fund and all that stuff. He had an IRA. He had $2,000 in his hand in 1982 looking for a home for it. He says, I could have done that. And that's such a powerful thing. So anytime somebody says, I want the next Microsoft or the next Apple or the next Amazon, or, you fill in the blank. My contention is you need to find the next Biomet. And it can be such a powerful thing in your investing experience. So that I'll leave you with that thought. I think that's just an awesome moment to point out what is possible. And you're never quite sure where they'll come from, as Ken was showing you with those actual club portfolios. So with that, I think we can close out with some images of our workhorses. And I love the Dalmatians. And I think many of us are very fond and familiar with the Budweiser Super Bowl commercials and the commercials over the years. So we'll just tip our hats in the direction of workhorses and cherish them. Your thoughts, Ken?
I'm just right on board with you, Mark. We're coming up close to our deadline right here. We do have a couple of questions that maybe we can answer. Here's a picture of us talking to one of our audiences. I think I recognize this room, and I think this might be a Seattle audience. Mark, what do you think?
You are correct, sir. It is Seattle, and we look forward to the day when we're doing this again, too. St. Louis is one of our absolute favorites. Not that we don't love all of you.
The car and drive there. That's a nice one, Mark. Okay. We have a good question from Gerald. And Gerald says, could you give me a little bit more idea about IRR, internal rate of return? And I don't want to turn this into an accounting lecture in any way, shape, or form, Gerald, but let me try to keep it really at a very high level. our clubs that I belong to, at least, never have enough cash to take a full position immediately in any particular stock. And in fact, we don't think that's necessarily a great idea, is to plunk all your money down in a full position right on one particular buy. So usually we have smaller amounts of money, which means in order to build a position, that mid-Michigan portfolio is worth about $1.2 million. And in order to build a position, you might have to buy a particular stock 6 or 7 or 8 or even 10 times before it's to the place where you consider it to be a relatively decent size in the portfolio. Well, all of those ins and outs have to be, and there's very few outs coming when you're building a position. They're mostly ins, but all of those ins have to be considered, and they have to be timed as far as your calculation is concerned. That's why I said you just can't take your initial investment and then look at what it's worth today and do a simple subtraction. IRR is an Excel formula. You can make Excel do it for you without knowing the mathematics yourself. A good standard article in Excel about internal rate of return will explain to you exactly how to set your spreadsheet up. And it's nothing more than setting it up the same kind of way that a passbook savings account used to be set up. Just make sure you include all the pluses and all the minuses. The computer will do the internal rate of return for you. All the different transactions need to be dated, and that's the key, that every transaction is dated, and therefore the actual amount of time that you hold the various pieces of the whole holding influences what that IRR is going to end up being. It's an easy calculation if you use a spreadsheet, and I encourage you to get involved with it. I will also tell you that if you're in a club situation, and if you're using iClub accounting software or Bivio accounting software, you're going to be able to write a report that shows the internal rate of return of all of the stocks that you have in your club portfolio. Ask your treasurer. If they don't know, then call up iClub or call up Bivio, and they'll be able to show you the buttons to push in a couple of moments. I wrote these reports. It took me all of about 30 seconds to get each of these reports from the different clubs that I belong to by just finding where the report was and then pressing the radio button and waiting for it to print out for myself.
Yeah, and I would point out that if you're using iClub or Bivio club accounting software, or the portfolio record-keeping stuff from Quant9 and Matt Wilms, that's exactly what they're doing to calculate the returns on individual holdings. They're doing that same type of thing that Ken was talking about. We also do the same thing for the roundtable tracking portfolio that we'll be talking about in a few minutes.
Pam Birch, recognize her husband Stan Birch in the front row of that Seattle picture, Mark. Okay.
Yeah, cool.
All right. And Bill wants to know, what's a full position? In a club, if we own 20 stocks, then a full position's around 5%, Bill. It's just 100% divided by how many stocks you own. And that doesn't mean we're trying to get exactly 5% in every one of them, but we'd like a position to be, and we use half the average to twice the average. So if we had 20 stocks, then a full position to us would be 2.5 to 10%. That leaves us a nice range to play with. But we don't want a position that's so small that it doesn't really make any difference whether you hold the stock or not. And we don't want a position that gets to be so large that the whole portfolio is dependent on a single stock. So a full position to us is the number of stocks divided into 100, and then we take half of that answer and double that answer, and that becomes what we look at as a full position.
All right, I'm showing 8:21, Ken, so we'll get underway in about 10 minutes. Any other questions to kick around?
I'm trying to go through them right now, Mark. It looks like we've covered most of them. And we want to give our audience that's going to be joining us, we already have a nice audience out there, and we want to really thank you all for coming. This is already an audience just about the size that we normally have at a round table. So let's see if that audience grows any as we get closer to
Sure.
8:30. And we're going to go back into chat mode right now. So if we've raised a question that I haven't answered, it might be time to send it to me again, because the list is pretty long and I've been scrolling through it. And if you'd just like to chat about something for the next 6 or 7 minutes, let's keep it stock related, but we'd love to chat with you. And what I'm also going to do is I'm going to allow people to raise their hands. So I've put a hand icon out there right now. Look at the icon before you use it. That's the icon for a lowered hand. I know it doesn't look like a lowered hand, but that's what it is. If you'd like to talk to us direct, raise your hand, press that icon, and we'll unmute you and we'll talk to you directly during our chat time right now. So take it away, folks. Let's do some chatting again for about 5 or 6 minutes.
Yeah, I thought Candace might want to take an opportunity to describe some of the stuff that goes on in St. Louis and just make sure everybody's aware of this type of stuff. So, Candace, are you?
I'm here. Can you hear me? Okay.
You're fine.
We can hear you just fine, Candace.
Okay, great. Well, we have a model club that meets every month, and we've had quite a few visitors coming lately, which has been nice. Every other month, we have a session called Let's Talk Stocks, and this is where people bring their ideas, and we share them at kind of a roundtable discussion in the St. Louis area. We also, it doesn't show it there, but we have a program called Classes to Go, where we go to clubs with classes of any topic. We have a whole list of them, but we're flexible too. So I think that's pretty much what we're doing. And what you have up is the St. Louis chapter local events page. So if you're interested, go there to the website that's shown.
Thanks, Candace.
Mark, Cheryl wants to know, what is too much of a position in a portfolio? And Cheryl, it really depends on how many stocks you have total. If you have 10 stocks, I would say that no one of those stocks should be more than about 20% of the portfolio. I'm dividing the 10 into the 100. I'm getting 10, and then I'm doubling it, and that gives me 20, which I would look at as the upper end of a holding in a 10 stock portfolio. In a 20 stock portfolio, 10 or 12% might be on the threshold of becoming too large for the rest of the stocks in the portfolio. So it depends on how many stocks you're currently holding, okay?
And yes, for those of you wondering, that is Mardi Gras paraphernalia in Ann Manning's hand. She's hanging on to it. So that was part of our red carpet celebration a few months ago. Ann has made some great selections. Qualcomm and Adobe come to mind, and that was from our award show. So,
yeah, we're talking to Nick, and he's getting into the difference between my personal club and the model clubs. And I will tell you, Nick, that a personal club made up of people that you've known for 35 or 40 years operates in a much different way than a very large model club of 24 or 25 people that get together once a month and that are made up of a wide variety of abilities and a wide variety of investment experience. Their behaviors and their actions are very different. Our clubs operate on the concept of no news is good news. But there's danger in that when you're working with partners that don't understand they have a responsibility to report problems with the company that they've been assigned to follow. Now, the model clubs try to mitigate those problems by assigning all of their stocks to pairs of stock watchers, but there are still times when those stock watchers are not as vigilant as probably they should be. Nick is honing in on the idea that my personal club does not have any big losers. And you're right, Nick, we try to move those out of the portfolio relatively quickly. That's not as easy a situation when you're trying to teach as well as manage a portfolio in the model clubs. So they're two different animals. They behave quite a bit differently because of the makeup of the groups. And again, a group of friends that have been together for 30, 35, maybe even longer. I don't like to admit that it's maybe longer, but I think it might be. They act a little bit differently than a group of people that I'm not going to say it's constantly changing, but we probably have a half dozen new members every year, and we probably lose a half dozen members every year in a model club. People find out that the method is a lot takes a little bit more time than they thought it might. We find out that people age and move away from our territory, and our model clubs, we try to keep them geographically close so that we can meet face to face. We've gone back to meeting face to face now with our model clubs, and we find that's a significantly positive component of the clubs. My personal club has managed to stay together for so long because we've allowed people to move all over the country and maintain their membership. And in return, those members have maintained their vigilance and their interest in the club. That portfolio is over $1 million as well. And that includes significant withdrawals for people that have put kids through college, bought houses, bought cars, paid off debts for their grandchildren, and done all kinds of different things. So that's a little bit longer answer than I wanted to give for a much more complicated problem than I want to acknowledge, I guess. Mark?
Well, I noticed you didn't tell him about the shock collars that you hand out to the members, and
Okay.
he does run a tight meeting, folks, and it's actually a wonderful thing to be focused on what matters. I mean, I consider that to be the most important thing of the modern investment club movement. You only have to really care about a few things.
What time are we approaching now, Mark? I don't have my watch
8:29.
yet.
We got 1 minute. Time for one more, maybe.
Okay, I'm looking. Nobody took me up on a hand raise. Okay, we're going to keep it up, but nobody took me up on it. Okay.
We'll have Q&A at the end, I think. With
All
just
right, here's a good one. Jane wants to know, does the model club invest actual dollars or is it virtual? Jane, when we first started the idea of a model club, we were only the second model club in the whole country. This is back before the year 2000, before the turn of the century. And we started with a virtual club, and we folded that after about 8 or 9 months when we found people doing really strange things with virtual money. We reformed the club about 3 months later, and this time started with real money. And you'd be surprised in the difference of seriousness and the difference of direction that money makes when you put that into a model club. So it's a real money club. And the folks that have stuck with it are extremely pleased with the results. All the clubs that you saw tonight have relative returns that have beaten equal investments in the Wilshire 5000. They're all returning better than the Wilshire 5000. So I'm happy for that.
That makes it more fun. All right, I've got 8:30. Do you want to go ahead and give us a formal introduction to this?
I will do that. I'm going to silence ourselves for about 3 minutes, 3 seconds. Here we go. Good evening, everybody, and welcome to the April 26th edition of the Mid-Michigan Roundtable. We'll be joined this evening by folks from the St. Louis Better Investing chapter that are co-sponsoring our event this evening. And as always, we have the president and CEO of Manifest Investing. Manifest is our true partner in this roundtable. We've been doing the roundtable for almost 12 years right now, and we'll show you some of our history, and we'll show you some of the things that we do to help ourselves become better investors. I'm joined this evening by my good friend Mark Robertson. Mark is the CEO of Manifest Investing. I'm also joined with Candace Baker, who's a director with the St. Louis chapter, and Ann Manning, who's a proud member of the Houston Better Investing chapter. This is the April 2022 Roundtable. My name is Ken Kavula, and I'd like to welcome you all.
Thanks, Ken.
This is an educational demonstration, folks. We're not making any recommendations that you buy, sell, or hold any securities. And in fact, we might own some of the securities we talk about in our own portfolios. We'll try to remember to tell you about that, but we're not even going to guarantee that. The purpose of this show is to educate, and everything that we do is for illustrative purposes only. Please do your own review, do your own analysis, do your own homework, and make your own decisions before you buy, hold, or sell any security. If you'd like to be reminded about this roundtable program, please send an email to my wife, Ann Kavula1, at Comcast.net, and she will be glad to add you to our guest list. Today, that guest list is over 1,000 people throughout the country that we remind on a monthly basis about the roundtable. And the roundtable is usually coming up on the last Tuesday of each month. But if we do decide to change the date, this reminder will let you know. If you'd like copies of the slides, they are going to be available on our YouTube channel, but they're also available by dropping a note to Mark R. at manifestinvesting.com. Mark would be glad to send you out the slides if you think you'd like to review them at your leisure. Mark, why don't you walk us through our agenda?
All right, this is our standing agenda. Like Ken said, we've been doing it now almost 12 years. It will be 12 years in July. We'll take a look at our performance results here in a minute, but again, we'll just kind of welcome everybody. I saw a lot of new names, so welcome to this. We do keep it fairly informal. As you see at the last bullet point down there, if we have some time left over, we try to run these an hour and 15 minutes and leave some time for questions and answers. We'll be talking about our performance results. We also do a form of portfolio management. It's a little bit different with a tracking portfolio, but we do demonstrate the notion of challenging holdings that deserve to be challenged, putting them on the hot seat. The presentations tonight for the stocks will be, Candace is going to bring Generac, GNRC. Ken is kind of stuck on his banks. He loves those regional banks and just banks in general. That's Western Alliance, WAL. Ann Manning is going to bring Houlihan Lokey, which is a company that we're a little bit familiar with thanks to one of those panel discussions back at a successful investing conference just not too long ago. And I wanted to bring Ardelyx, but Ken won't let me. That's ADRX. We've got several positions in Ardelyx, and what I'm going to do is double down on Candace's selection of Generac, and we're going to double team that one. That was at the very top of my list, so Candace and I are going to both share some thoughts on Generac, and I think we'll have some fun. We do invite everybody to participate in an audience poll, so please do so.
Mark, before we finish the session tonight, could you double check the ticker on Ardelyx?
No, that should be ARDX.
That's what I thought. Okay, we'll fix that, folks, before we send this out.
Okay. All right, we've been doing this for almost 12 years. The intent is just simply to share a good study. We think that all stocks should be studied carefully, and these happen to be some stocks that kind of rise to the top of our potentially actionable. And by actionable, we do mean study, review the situation. And our goal is to build a tracking portfolio that beats the market by 5 percentage points. Over the long term, we measure the market by the Wilshire 5000. And we'd also like to see the majority of our selections outperform that market over time. And we're coming fairly close to that, so we'll keep cranking away. Candace already covered this. Basically, there are activities in the St. Louis area if you want to become aware of. You can go to the Better Investing page, drill into the St. Louis chapter under Missouri, and there's contact information and a list of things that they're doing. I think I might stop in on one of those Let's Talk Stocks here pretty soon.
Great. Love to have you.
All right. Now, Candace, this is one of our favorite clubs anywhere in the country, and I know you know these ladies.
Absolutely.
Oh, man. The Broad Assets Investment Club, the ringleader is Ruby Lawrence. They're in the middle, but really a formidable club and wonderful group. And the reason I bring them up here is I just want to tip basically a trophy. They've got a complete trophy case full of trophies. They have won our stock picking contest at Manifest Investing 3 times. And I think that's pretty statistically significant. They won 2 years in a row, 2012 and 2013, came back 2 years later and won it again. And one of the things that we kind of notice about the selections, when they're winning that much, and they're always at the top of the leaderboard, I'll show you in a second how consistent they've been. But one of the things that we noticed is they very often had a pick, which was the kind of company that was just really beginning to emerge with earnings. And we refer to that as launchpad or escape velocity investing. And I really think it's been a nice addition to some of the stuff we talk about at Manifest. And Ruby and I have had some wonderful conversations over the years. And they're just a treasure, just a treasure. All right. Here's one of the other things. I know this is a busy slide, but I just want to make the point that they've been in the contest about 10 years. They're always on the leaderboard. And between them and Susan Michalek's club up in Janesville, Wisconsin, it's really refreshing and exciting to see, a club that's been around 10 years beating the market by approximately 10%. That's per year, folks. And that's the reason that we wanted to acknowledge them and basically give them a cyber ovation. So cool stuff. All right, well, back to the roundtable itself. Here's a look at our actual performance over the last several years. Again, like we said, we're coming up on 12 years. What you're looking at here is just the monthly kind of a pin map. Our rate of return since inception is 16.5. By the way, that was almost 18 not that long ago. But the interesting thing is, while the market's fallen back quite a bit, we've actually gained during this pullback in the market. And this has actually gone up in the last month. You can see that it's slightly higher. The blue dot, the 16.5% compares to 11.3 for the market now over that same time frame, meaning that we're beating the market, measured by the Wilshire 5000, by 5.2 percentage points. And the red dotted line is kind of that traditional 5% line that you hear Ken talking about all the time. That's the threshold or the objective of many investment clubs and many investors within this community. And we're just glad to be hanging out around that red line. Any thoughts, Ken?
I am just very pleased that we're back above our benchmark there again, and I'd like us to stay there now for another couple, 3 or 4 years. We had a really good run of it. I got a little bit worried when we fell beneath, but we've kind of clawed our way back here. That's good.
All right, let's keep tracking on. Here's the actual portfolio. What we do, keep a tracking portfolio. You can access it via this public link at the bottom of the page. This happens to be the 20 largest positions by percent of assets. The top 20, there's about 70 positions in the portfolio. And kind of the way you break this page down is we invest $1,000 every time a stock is presented, either by a knight, a damsel, or by the audience vote. And so we invest $1,000 into them. In the case of Microsoft, Microsoft has actually been nominated over these past 12 years 5 times. You see that here in the legend. So $5,000 invested into Microsoft has become what you see here. And we'll take that any day. I don't care how much they beat up on it on the nightly news tonight, Ken. I like that number. And I suspect we'll barely notice. But you can find...
Well, the Mid-Michigan folks know that Microsoft is my largest holding in my personal portfolio as well. I made no bones about that when we just taught the Adding Judgment series at Better Investing, but I'm not especially worried, and especially after taking a real deep dive into Microsoft in the last 6 weeks or so, I'm just kind of encouraged by all the things that are going on, and I think Mr. Nadella needs to wear a big gold star on his lapel. I just think he's doing one heck of a job.
Well, you can see these top 20, they include a number of household names, but there are a few companies there that are a little bit off the radar screen for many average investors. But there are some really neat ones there. I like Regeneron. Regeneron's actually done quite well. That was presented at a national convention. And then a couple times over, I think it's been selected. How many times is it? Is it up here? 5 times, I thought.
7 times, Mark.
7 times. Well, that shows you how much we like it. Of course, the all-time leader in selections is Cy Lynch and his Cognizant Technology, and that's doing okay too. And then every once in a while you get an Amazon. 2 times, $2,000 has become almost $20,000, and then a one-time selection in Costco. Not sure why we never went back to that one. Anyhow, there we go. All right, let's talk about companies that might be somewhat, on the hot seat. And what you're looking at here is just a cluttered slide showing you the types of stuff that we look at for the portfolio. That's the report card up at the top. We do want to keep that quality okay. That's in pretty good shape. We would love to see us in the target range for the sweet spot, and we're a little bit short on that. So again, we want to make sure we pick good companies tonight and maybe shed 1 or 2 that aren't serving us quite so well. The financial strength is good. The growth, we always want that to be somewhere within striking distance of 12, as you heard us talking about last hour. The 3 companies that have the lowest return forecasts are shown right here. So they're sorted by the return forecast, and these are the ones with the lowest pars. And now those are consensus judgments of stock studies. You'd want to always audit for your own decision making. But again, those numbers are not terrible. I mean, they're low, but they're not terribly low. And the one that kind of jumps out for a number of reasons is United Airlines. Kind of an opportunistic play by Hugh McManus a couple years ago, and we'll talk about that in greater detail. We also keep track of the companies that are actually lagging the market the most. And I've actually set Ardelyx aside here because it's really lagging and would blow the chart up. But here's some fairly interesting, fairly recent companies, and I like most of those companies. Yet it just shows you how challenging the market has been here over the last few months. And last but not least, and then we can open up for discussion, United Airlines actually does show up as a company that is potentially overbought. The relative strength index has spiked up above 70. So showing up in 2 places, I'm not so sure we shouldn't maybe have a thought of taking advantage of United Airlines. I've got a stock price chart to look at in a minute. But anything really flag here for you, Ken?
Yeah, I understand our rules about rule of 5, Mark, but I'm not sure they're as valid for us during significant downward moving markets. With that being said, I really would like to put maybe 20 minutes or even a half an hour into that discussion at our next roundtable about rule of 5. And maybe we have to loosen our 25% threshold a little bit, but I am concerned about the stocks near the top of this list. They seem to be in free fall at the moment. That leads some people to believe, how much further can they go? And I keep reminding myself they can go to 0. and I will never, ever end a stock presentation with what's not to like again. Those were my two presentations in January of Facebook right before it started its plunge downward. The only one on the list, Mark, that I might suggest we jettison at the moment is Yum China. I just have terrible feelings about these Chinese stocks or these stocks that derive most of their business from China, and we might want to take that one off the list. But that's the only one that I would recommend tonight.
Yeah, that was kind of my bright idea, and I think it still may be all right. But boy, the near-term outlook, for many reasons, is tough. Yeah, your Facebook comment will go right down with my how low can it go. Yeah, interesting stuff. Malibu boats, I have great faith in that one. LCI, I like PayPal among the best on that list. So I think doing individual studies.
And I agree with you that freeing up 1% of the total portfolio by taking the profit in United Airlines, there's nothing wrong with that, Mark, especially since it appears to be overbought at the same time.
Yeah, and here's a look at Hugh's opportunistic moment. This is a stock price chart from Stock Charts, and what is shown here on the left is Hugh actually came in, and he doesn't make a lot of meetings here lately, but we hope to see him again soon. He's been very busy with COVID. But back in this time frame when they basically shut down travel, United Airlines basically tanked from 90 down into the teens. And he basically said the thing that he often says, I don't see this company disappearing from the planet. I think this is a buying opportunity. We may have to wait. And sure enough, I mean, look at where it's gone since then. Now, it has been tapering off a little bit. It peaked up to here. It has been tapering off a little bit, but it is in a position where it's, again, it's a situation where it was an opportunistic situation, not necessarily a traditional buy and hold situation. So I say take your $3,000, which became $5,500, and celebrate around the water cooler.
Agreed, Mark.
Yep. So I think that's what we'll go ahead and do, and wait for the next unusual moment with you. Okay. Any other comments on any other aspects of the portfolio?
Well, I do think we should unload Yum China as well.
Okay, I'll let it go, even though it's one of my favorites.
That's
Mark, you
that's
never
just insurance in case it goes up, Ann. That's all that is. Okay, that's just insurance from Mark in case it goes up really big.
Well,
He can do an "I told me so." Then
Exactly. But he never wants to get rid of his.
I know.
I also want to point out that Mastech was probably my idea from 1 hour ago.
What in the Baker Club?
Yeah.
Okay.
He'll take all he can.
Especially
And
if
that's
they're near the top of the chart. Doing well. All right. So with that, I think we can go before I bury myself any more deeply or deeper. Let's go ahead and kick off the stock presentations. We're going to start with Candace, and I really like this company, so I'm going to circle back to this one. It's my turn. So go ahead and take us away, Candace.
Okay, thank you, Mark. I picked Generac. The ticker is GNRC. It was founded in 1959. And they introduced the first affordable backup generator and later created the categories of automatic home standby generators. And now they're into different areas and one of the leading energy technology companies. Next slide. It's in the industrial sector under specialty industrial machinery. It's a mid-sized company, according to Better Investing, with $3.7 billion in revenues in 2021. As we'll see in a future slide, as far as manifest and the growth rate, it's really a small company because their estimated growth is about 16.1%. They are a leading designer and manufacturer of those generators, and they have almost over 75% market share. They have generators for residential, commercial, industrial, construction, and they're used in the military as well. They have all different kinds of fuels, natural gas, diesel, liquid propane, and biofuel. They're really expanding into the clean energy area with using some decarbonization, and in expanding into the solar inverter and energy storage systems. They have a unit called a power cell, and with this, it also will store the solar energy, but energy from the actual electric grid, so that it can be used when energy maybe is at a peak demand period and more expensive. You can control this. Next slide. I thought this was an interesting comment in the last value line. With increasing threats of cyber attacks against vital infrastructure and worsening conditions of electrical grid systems, both residential and commercial customers are choosing to have a safety option, especially those people who have home offices. I think it's become very important. So what was previously viewed as a luxury is becoming a necessity. So I think this company is kind of in the sweet spot. Next slide. These are some slides from the company's website. It kind of tells you a little bit about what they do. They have the standby and clean energy and some portable generators for residential. About 85% of their net sales in 2021 was domestic, and then 15% international. They do have a small portion in Russia. They said it was about they pulled out of Russia, and I think it was less than 1% of their revenues there. They do then have the commercial and industrial products, stationary generators, mobile generators, and things used in the telecommunications. They also have the aftermarket parts, product accessories, extended warranties, grid services, and remote monitoring. Next slide. This kind of shows that they've created a whole ecosystem. They have the generators and storage units, and then they have all the monitoring and management devices, and the different platforms to control all of this. And a lot of it, I had seen an ad on TV for the power cell, and you can control everything from your smartphone, which is kind of exciting. So all of these energy distribution centers are part of their ecosystem, and they're into decarbonization, digitalization, and decentralization. Next slide. I thought this was an interesting one. With this power cell, their competitors are Tesla, SolarEdge, and Enphase. And what the footnote says, which you probably can't read very well, but it says that the shaded lines for power cell represent the market-leading advantage that they have in terms of power capability, specific percentages as compared to Tesla in usable energy, continuous power, and peak power. So they, even though they're a little bit late to this part of the energy complex, they really have a good product. Next slide. This is a slide showing what they anticipate. I mean, we have really had a lot of growth in residential products, and still a lot of growth to go. Only about 5.5% of homes currently have standby generators. In the state of California in 2020, most residential construction was required to have solar panels, and in 2023, that's going to be a requirement for commercial buildings. So there is a lot of growth here. Next slide. And this kind of shows what they're anticipating in revenues going forward. In the past, 19% growth, and their growth themes are power quality issues that continue to increase. Home standby penetration opportunity is massive. Solar storage and monitoring markets, grid services and energy as a service, natural gas generators driving superior growth, and then the rollout of 5G requires more improved network quality. Next slide. This is a slide for Manifest, and if you're doing a stock search on companies that are in the sweet spot, you can see Generac showed up there with that growth of 16.1%, quality of 97, and a projected annual return of 17.6. So I thought it was a good candidate to look at. Next slide. This is kind of a slide of information off of the value line. Back on March 18th, it was at $312.35 a share. When I did this slide on the 21st, it was $241. It closed today at $229.95. But you can see even at $312.35 when the value line came out that that price was below the value line. So that makes it kind of attractive to go up. They had a projection of annual total return of between 11 and 23% with an 18-month target of 359. It has company financial strength of B++, which is, pretty good. Not the A++ we like, but it is a smaller company that's growing. As I said, the value line has that 18-month target of 359. Some of the others, Yahoo has a 1-year target of 445. Morningstar has a fair value of just 301, and CFRA a 12-month target of 350. So it seems like there's a good bit of upside. Next slide. This is the front of the SSG on SSG Plus, and I think, Ken, you like this? To me, that's pretty up, straight, and parallel. I kind of like that. The little dots in green and blue are analysts' expectations. So I think my estimates for growth are a little below that, a little more conservative. You can look at the latest quarter. Their sales came in at 40.2% and earnings per share at 3.6. Now, they, like a lot of companies, those earnings were hit because of the supply chain and logistics challenges that companies had, but their sales have been phenomenal. I had forecasted a 15% growth, which, with the 5-year estimate was really kind of conservative compared to what Value Line had. I then used, I think we'll see that on the next slide, preferred procedure, which then came out with the 17.3 in earnings per share. And that also, that 5-year estimate was a little conservative compared to Value Line's. Next slide. This kind of shows, over the 10 years, that growth of 11.2, but look what's happened as we've come out now. I mean, in 20 to 2021 at 50.4. So, I mean, phenomenal growth has increased for this company. Next slide. This kind of shows section 2 of that SSG, looking at pre-tax profit on sales. So they have been going up nicely. Return on equity is great. And the debt to capitalization is a little bit over like the 33% we kind of like to see, but it actually is a little bit less than the industry, and it has been coming down. So not bad here. This is a little snippet of the value line that shows the prediction for net profit margins, and you can see that they expect that in the next 4 to 5 years that it's really going to be moving up, which I think is a good sign. You can kind of see my preferred procedure calculation that came out with where I started with the 15% and came out with earnings per share of 17.3, and that put the stock at the price, which actually was higher than what it is today, in the buy zone with a total return using the high PE of 17.3, or a projected return with the average PE of 9.7. Next slide. I think that's it. Any questions?
All right. Well, we'll hold questions so we're done, but excellent. Thank you, Candace. Intriguing company, and I'll circle back to it.
Okay, great.
All right, Ken, Western Alliance. This has been the repeat selection, right?
No, this is the first time for Western Alliance in the roundtable portfolio, Mark.
Oh, okay. Well,
yep.
We can't allow that to persist.
All right. This is a regional bank. They're headquartered in Arizona, Phoenix, Arizona. And you can see that they win a lot of awards. They were the #1 best performing bank of the 50 largest public banks in 2020, according to S&P Global. They've made the top 15 in the best banks in America 2016 through 2021. And Institutional Investor calls them one of the most honored companies in America in 2021. I discovered Western Alliance Bank back around 2016, 2017, while looking at the Forbes Best Banks list. And at that point, I was looking for some very specific things in banks, and we'll talk about that as the presentation continues here. Next slide, Mark. I pulled some graphs right out of their investor presentation. They're a very traditional, very conservatively run bank. Their geography is northern Arizona, southern Nevada, a little bit of eastern California. That's kind of a sweet spot for the bank right there. What's very interesting is during the Great Recession in 2008, the federal government asked Western Alliance to step in and absorb 3 other banks that were in the same general geography and absorb them so that the banks would not fold and leave the customers high and dry. Western Alliance stepped in, brought those banks into their company, and made them as profitable as Western Alliance has always been. You can see that a little bit less than half of their business is straight up residential and consumer loans like traditional banks do. Banks love to use acronyms, so I had to really search for some of these acronyms, but CRE stands for commercial real estate. Why they couldn't have just said that, I don't know. NOO stands for non-owner occupied, and the other category is commercial real estate owner occupied. And that's about a quarter of their business. C&I stands for commercial and industrial properties. And that's about 20% of their business, and then they have a small portion that's kind of I spoke. Mark, I just lost my presentation here. Are you there?
I'm still here. Yeah, I'm still here. So it's on our screen.
I got it. Okay, that was something coming from Skype. I have no idea what that was, but coming from Skype there.
Probably your broker
checking
in on you.
Yeah, it didn't look like a broker. Loans by borrower type, you can see the different types of borrowing right there. And the other thing that, the only other thing that I couldn't figure out was C&D, and those are construction loans by borrower type. But the point of the slide is it's a very traditional bank, not a very complicated business model. Next slide, please. I'm looking at loans from 2013 to the second quarter of 2021. The compounded annual growth rate of their loans is at 19% compared to a peer value of about 11.5% and a top quartile value of about 13%. Ross Meredith, our bank examiner in our Volunteer Nation in Better Investing, calls loans the lifeblood of a bank, and loans, if they're not growing, then the bank is not something you want to have in your portfolio. This is extremely healthy loan growth for this bank. Deposits are also very important, and you can see that their compounded annual growth rate for deposits is about 30%. We're looking at a couple of different things on this graph right here. The dark blue are interest-bearing deposits. The light blue added to the top of the bars are non-interest-bearing deposits. And then we get total borrowings at the top of the bars and the cost of funds, and that dollar amount actually is decreasing. Now, interest rates are going up, so we will expect those dollar amounts, those percentages of costs of funds to begin to increase again. But this bank has a very low cost to doing business. Next slide, please. Here's 3 charts that you can take a look at and notice that Western Alliance, which is the darker bar in each case, and the peer group, which is the more blue bar, reserves to total loans. Western Alliance does not feel that it has to carry the reserves that a lot of other banks have to carry to cover bad loans. And that's because their percentage of non-performing assets, read bad loans if you want, that ratio to total assets is extremely low, 0.2% compared to 0.35% in the peer group. You'll see that their charge-off for loans is virtually at nothing. They have virtually no non-performing loans to have to really deal with in the bank. Another measure of how conservative they are and the standards they set before they will loan money out. Next slide. Here's my up, straight, and parallel. It's practically a picture book. I love the fact that the current price, the tick mark, is down near the bottom of the 52-week range. That's that red circle right there. I think I might have a stock that's really on sale. Growth in the most recent quarter looks pretty decent. The dotted lines are my projections going forward. Next slide. And those projections were at about 13%. Look at the historical growth. The 10-year pattern was around 21% for sales and around 26% for earnings. So I'm setting a very conservative sales and earnings growth projection. I'm under almost any of the resources that I was able to pull up. There is no standard value line for this company. There is no Morningstar report, analyst report for this company, but there is a reasonable amount of information available. And I went to the very conservative end of growth to put together an SSG. I'm hoping that it says buy, and if it says buy with extremely conservative numbers, then most of my surprise will be to the upside, and that's what I like to see when I'm buying a bank especially. I pay a lot of attention to the newer numbers that are coming only for banks with our data set, and that's at the bottom of the second set of numbers. It's called percent return on average assets, or ROAA. And just to give you a feel for that number, an average return on average assets is about 0.85 or 0.9. A really good return is about 1.25. And when you start seeing numbers up around 1.5, 1.6, 1.7, 1.8, you are looking at a superior bank, especially if you see those types of numbers over a reasonably long period of time. I think if you look at Western Alliance, you'll notice that it goes above 1.5 in 2015, and then it stays there all the way through the fiscal year 2021, the last fiscal year, 5-year average of 1.86. These are superb, outstanding numbers. And again, using as a source our friend Ross Meredith, who has done a lot of workshops on banks that are available in the virtual learning library on the Better Investing website. Ross makes it clear that as far as a bank examiner is concerned, this is one of the most important numbers that a bank can display to the general public. It tells him almost immediately the quality of the bank he's looking at, and I'm looking at an extremely high quality bank. Next slide. I showed you a graph for upside downside here, as well as the buy, hold, sell bar. the current price, that $80.20 was the close on Monday. I didn't get the close today, but the entire market was down. I'd be surprised if this stock wasn't down as well a little bit. So let's assume the price is 80.20 or less. A good solid buy, a good solid 8.3 to 1 upside downside. That's a reward to risk ratio. I really, really like the positioning of the price for this particular bank. Next slide, Mark. I'm looking at a par value, projected annualized return at an average PE ratio. I'm looking at about an 18% par return, 17.7 to be exact. That compares with manifest par number of 17.1. We're using slightly different methods, but we're coming awfully close in the results. And that gives me some validation for the process that I'm using. It makes me feel that my SSG is sitting in a really good place. The best case return might be as high as 24% or even higher. And remember, if growth rates exceed my 13% that I used on the SSG, then these numbers will all be higher, not where they're at. So all in all, I'd like to take a position for the roundtable in Western Alliance Bank.
Thanks, Ken. Sounds like it's long overdue. And I propose we do another one of our Breaking Bad series, since this is a Arizona bank.
All right.
That's probably why their bad loan ratio is so low. I probably use some of those methods. Just kidding. Just kidding. All right. So Anne would like to bring Houlihan Lokey to the roundtable portfolio. So take it away, Anne.
Okay, thanks, Mark. Good evening, everyone. We're certainly glad you could attend tonight. We certainly have a large group. When Mark asked me yesterday to present a stock, I thought I wanted to find a new stock for the roundtable portfolio. And in my searches, that kind of was getting real hard to do because there's been so many good stocks presented. I actually had thought this stock was already on the roundtable portfolio, but I finally realized it wasn't and decided to do it. It was actually presented by Pat Donnelly on one of the COVID conferences, and I have to give him full credit for finding this great stock. It is an investment bank and a financial service company with headquarters in Los Angeles. They have 3 divisions. They handle mergers and acquisitions. They have a financial restructuring division that helps their clients during bankruptcies, both in and out of court situations. And they offer a financial and valuation advisory service. And I have to admit, I was not sure what the last division did, so I Googled it. And I'll read you what the definition of what this service would do. It is the practice of forecasting the free cash flow of a business into the future and discounting it back to its net present value at the weighted average cost of capital. This is used to value companies during mergers, acquisitions, and capital raising. And this would obviously be very helpful in their other divisions to have this information. Next slide. This is a summary of the company. They were a private company that started in 1972, and they went public in 2015. This shows you an overall look at the company, and they have locations worldwide. They obviously don't employ very many people to service their 2,000 plus clients every year, but they have managed to raise $2.6 billion in revenue, even with a small amount of employees. Next slide. I was impressed with the length of time that their top management has been with the company. You can see it's quite a few years. They're a company that likes to find talent within the company and promote them these employees internally. They don't want to be known as a company that just has a few stars that are generating their business. So they obviously have a strong loyalty among their employees. Next slide. As you can see, they have 37 locations worldwide. They're pretty much across North America. And in 2021, they acquired a company called GAC Corporation, which was out of Japan, which has certainly increased their Asian presence. Next slide. This slide gives you a breakdown on how their customers are divided among their products. I particularly like that their business is spread out among the different industry mixes. They don't seem to be relying on large transactions to carry their companies. If you'll see at the top, there's no single transaction has represented more than 2% of their revenue. And the same thing, there's no individual broker represents more than 2% of their revenue. So I like that. And they certainly have room to expand geographically in other parts of the world, since at the moment they're mostly in the United States. Next slide. Here you can see the acquisitions that they have done since going public in 2014. And I'm sorry, this is so small, but this is what they had on their website. These give them more variety in their industrial mix and also in their global reach. I wish I knew how they grew the company before they went public in 2015, but I could not find out that information. Next slide. You can see the corporate finance division is certainly their largest division, which is the merger and acquisitions. The revenue for each of the divisions has grown, but each segment percentages seems to remain somewhat consistent. And you can see how they have grown across since 2015. Next slide. They are up against some of the more well-known financial companies. In these 6 industries, they had the most transactions in 2021. I mean, we've obviously all heard of JP Morgan and Goldman Sachs. I'm not sure about the other ones, but I was quite surprised that they were such a leader over those companies. Next slide. They have been #1 in the merger and acquisition advisor in the United States for the past 5 years. They have been #1 global restructuring advisor for the past 6 years, and the #1 global and merger and acquisition fairness opinion advisor for the past 20 years. To me, it's interesting that they're such a big player, but they don't seem to be very well known. They are a very low-key company. They have been involved in some well-known bankruptcy litigation. They were with GM, Lehman Brothers, and the infamous Enron. Next slide. Since going public, all 3 of their business segments have grown. Corporate finance has grown at 17%, financial restructuring at 21%, and financial evaluation opinion is at 9%. If you go on their website and look under investor relations, you will find a much lengthier slideshow than what I gave you here. I probably only gave you maybe a third of them. And if you're interested, I would suggest that you go and look at their presentation. Next slide. This is from Manifest Investing. As you can see, Houlihan Lokey has the biggest quality in this group, and they also have the largest growth potential. They may not have they're behind Lazard in par, but they have more growth potential. And they are also, you will find them in the sweet spot screen today. Next slide. This is our familiar manifest equity analysis of Houlihan Lokey, and even with the recent drops in the stock price, you're getting a 15.9% projected annual return with a projected average price of $168.14. Next slide. Nothing shows you better the growth of this company than the SSG front graph. Their sales and EPS growth has been steady. and I felt like the 13.2% was a reasonable estimate for their future sales and EPS growth. This is in line with both manifest and value line predictions. Next slide. The management certainly appears to have a handle on their pre-tax profit and return on equity. They have a low debt ratio. In section 3, you can tell that, again, their numbers are pretty consistent. There are no real wild swings in any area. The price is down from its 52-week high, but it's not really any different for most companies in the current market. Morningstar gives them a 4-star rating and a fair market value of $104.52. Next slide. I chose to keep the high and low PE what the average was since they are so consistent in the last 5 years. I selected a low price of $68.20, which is 80% of the current price, which is usually what I do on my SSGs. This will get you in the buy zone, and your 3-to-1 price would be $92.51, which is above the present price. My calculations resulted in a par of 13, which is below manifest 15.9. All right, I guess that's 12.7 now. Next slide. If you will go and look at the value line page, you will find that the Houlihan Lokey is a triple play candidate. It has a depressed price. There is room for both PE expansion and net profit expansion. And they have a timeless rating of 1 from value line for the coming year. I do own this stock. I purchased this last May after Pat recommended it. And even with the price pullback, I have made a 30% return this year on the stock, which I'll take any day. So I hope you consider this stock, and I hope it is something that you're wanting to go and look for in your own portfolio. Thank you.
Well, thank you, Ann. Excellent presentation, and thanks also to Pat Donnelly. This is I don't know what to say, Ken. These are three awesome presentations. I've got some work to do to keep up with you guys. All right, here's our Ardelyx. Yes, Ken, the ticker is ARDX. I just wanted to give an update to those that have been following along. This is like an 8 or 9 time selection for the roundtable. It's infamous for being denied by the FDA almost a year ago now. That was this price drop right here from $9 ultimately to less than $1 when their kidney treatment was denied. There has been a change in management at the FDA. That's what largely caused the uptick back in December. I'm not recommending it today. I'm just pointing out that there was a 40% gain the other day pre-market. And the reason they did that is they have approached a different aspect or a different component of the FDA to convene this advisory committee for this same denied, what it is controls the phosphorus in a kidney dialysis patient. And anybody that has had a family member in that situation knows that anything that will give relief or be contributory to the better patient situation. And that's what they believe they're seeing. And they continue to keep trying, and they're persisting. Again, all of the catalysts that we itemized over the last few months are still in place. And their partnerships are developing. They are going out to market with the irritable bowel syndrome drug that has been approved. So they do have an active drug in the marketplace. They have more cash in their checkbook than the stock price per share. And they continue to make progress with the FDA. That's your update. Ken won't let me actually put it on the poll, so that's all I can do for this tonight. So I had to go back to, I ran a quick ivory soap screen at Manifest. I like to go looking for companies that have outstanding quality and relatively high return forecasts. We call that the Manifest rank. It's a combination of these two things. And lo and behold, Candace's stock ends up at the top. And one of the things I promised myself I would do this month is not get too fancy and basically go with a company that ended up near the top of this without doing an inordinate amount of gymnastics to justify anything. So I'm going to stick with, I'm going to double down on Candace's selection of Generac and just kind of point out a few things. All right. She already covered some of this. I just wanted to give a little more color to the situation. I actually wrote this article for Better Investing many years ago, When Squirrels and Birds Get Hot Feet, and it actually detailed a situation where my son and I were camping up in northern Michigan when an outage hit that actually took out, actually was almost a third of the population of the United States at the time, and it's shown in that satellite picture there. The electricity was off for days in that spot in most of Michigan. And we came back from the camp and couldn't get through to the house on the phone. We stopped by Home Depot and bought some hot dogs and came home. And, it was just a nasty situation. Lo and behold, at that time, the water pumps for the city were actually run by a generator which had no power and could not actually function. In addition to that, all of the gas stations were no longer pumping. So you've got, just think about the situation you have. So that's kind of where this Generac thing comes in. It's actually taken off quite a bit since that time frame. By the way, there's a sub story here. We came home, we got out the board games, we took all the meat out of the freezer and had a barbecue. We played games for days. And the interesting thing was when the power came back on, like 4 days later, our son actually went around the house and turned everything off. He didn't want it to end. So it's kind of a neat story. All right. Candace has already described it. That's a picture of one of those devices by the house there, one of the Generac units. Value Line comes out with some fairly decent paragraphs on the situation. Very well positioned, much like she pointed out. She's already pointed this out. I just wanted to emphasize that, yeah, this stuff is happening. You basically have wildfires taking out all kinds of electrical transmission in California. That's because the system's run down and needs to be fixed. And that's not going to slow down in various areas of the country. You can actually go to the Energy Information Administration and access maps which show you where the fires are happening and where the power is going out. It's amazing. They keep track of this stuff all the time. In combination with that, you do have all this stuff going on with electric vehicles and all the various things. As she already mentioned, the home is a sanctuary and an office for many people that are working from home. It used to be just an inconvenience if the power was out at your house while you're at the office. Well, now your office is at your house. So it changes the situation completely, the situation for them. So here's kind of a look again from Generac of how that situation has been. It's actually getting worse, and it will worsen until we reach a current state of readiness for much of the electrical distribution system in the United States. Some areas of the countries are more dramatically affected, but there's a whole bunch of areas of the country that have a lot of generators, and they are increasing. Here's a quick look at the company, focusing in on the visual analysis. The trends are good. Up, straight, and parallel. The pre-tax profit shown in this pink line is pretty good. Do want to talk a little bit about that bathtub that we see there, but we are looking at something in the 15%-ish growth range. The red lines could actually top that, and the profitability has been fairly steady and just a whole lot of really decent indications. So let's talk about a few things. As she pointed out, the stock price did hit a high of $524 fairly recently, and it is actually down around $233 as of tonight. So it has come back. The graph shows you the monthly price bars going back to 2010. It has taken excursions. Excursions are not something that should surprise us, but the overall trend is actually quite powerful. And I like the outlook a lot for this company in this situation. One of the things I'd like to speculate on a little bit is a little bit of that trough in the sales graph over time. I haven't had time to really dig in to see if that is really what's going on here, but there was an awful lot of subsidizing and encouraging and incentives for expanding battery stations and battery installations in that time frame, as is shown there by the EIA graph at the bottom of the page. I think that had a little bit to do with what's going on there, because they at that time they would have been competing directly against the battery storage option. even in residential and some commercial situations. So that kind of helps to understand a little bit about what's going on there. And then as she pointed out, they have expanded beyond that. And you see the electric vehicle up at the top there that's plugged in. You see the solar roof, and they are involved even in distribution stuff. So they're working with a number of, in some cases, competitors, but a lot of partners. And they have a fairly broad pursuit of product range that I think is fairly fascinating. The type of company that they appear headed to become. A lot of very, very much household names on that list of partners.
Mark, we're getting a really good question here. We'll keep that slide up that you had just up, the one before this one.
This one?
Are they actively into the business of making power charging stations for electric vehicles?
I don't know exactly. I do want to take a look at that, and I think it comes down to what role they play in these partners here. ChargePoint being specifically one that can be looked at to actually answer that question. So I'll say I don't know, but I know where I'm going to look to understand what their scope of supply is. You know, we talked last week about Littelfuse and that company and how it was involved in virtually all of that type of equipment, regardless of manufacturer. I think we kind of have a little similar situation here, where these guys are distributed quite broadly across all of these different challenging areas and fields of opportunity.
Okay.
Here's a look at the geographic potential. And I don't think I need to say much here. I mean, with all that's happening out west and in some of those other states, I think they've got a tremendous opportunity for providing solutions nationwide. All right, so here's the profitability, very consistent, whether you look at it at the operating margin level. Sometimes that's more telling. It's certainly more stable. In this case, the net margin is always going to include a lot of financial items and in many cases just accounting conventions and tax-related adjustments. So that's the difference between the two. But you can certainly defend the 18%-ish number that Candace mentioned earlier, just looking at that general trend. Here's the PE over the last several years, and you can certainly defend something in the low 20s, especially with the field of opportunity that these guys seem to have in front of them. So PE somewhere in the low 20s makes a lot of sense also. So again, coming back to the major highlights, growth rate, again, about almost a $4 billion company now, growing at about 15%. Their projected operating margin, Value Line said 28%. I'd be more comfortable with something down around 25, so I ratcheted it down. Value Line was using a PE of 27.5. I'm more comfortable something in the low 20s. That net margin of 17.9 makes sense. Again, you end up with a projected annual return of about 14. Very high quality company. Actually, a fairly low number of liabilities, and their projected return on value is fairly consistent with the 14 that you see. We like to see that. They're basically oversold with the way that price has been driven down. What debt that they do have is at a very attractive interest rate. You can see that they're very close to their 52-week low. There's a whole lot here to like. The low price forecast from Value Line is 460, so think of it as almost a worst case estimate. No guarantees, but certainly an interesting position to be in. And as Candace said, the fair value at Morningstar is $300, so you've got an 80%, or at least a 20% upside from where they're at right now with respect to that fair value. So a lot of good stuff here. And I'll leave you with one last thought that I've always found to be kind of a real kicker for me as I'm studying a company, especially a smaller company in a region like Wisconsin. These guys are centered in Waukesha, so I went and I Googled Generac and news, looking for news items. This is a fairly recent article. It's from just a few months ago, and they're hiring 700 new positions at a variety of places across Wisconsin and investing $53 million in their campaign to expand out into some of those areas that we talked about. And again, when we're dealing with one of the smaller companies, like I say, one of the real positive kickers for me is, unless they're evil in management at Generac, and I don't believe they are, you don't hire 700 new employees if you don't have a pretty good feel for, what lies ahead, what the road looks like lying ahead. it's just a real positive sign in what they think they can accomplish. And just a real positive feather in their cap when it comes to this type of stuff. So we'll leave it at that, and we will add a second dose of Generac to the portfolio. So with that, Ken, I think we can go to the poll.
The poll is open. You could vote for one of these three stocks for us to add an extra position. That'd be an extra $1,000. This is all virtual money, folks, but we do take this pretty seriously. We want the Roundtable portfolio to serve as a great example for our members. I'm just kind of talking to fill time here. We'd like to get about 80, 85, 90% of you voting. We're up to 70% voting, so just play along with us and pick one of the three companies. If you didn't like any of the presentations, then pick none of the above. We just pushed into the 85% mark. I'm going to kind of count to 10 in my mind here, and then I'm going to close the poll down. And here we go. Ann, I feel that Mark has ganged up on us, okay?
Yes.
You do feel like that, don't you?
Ann and I are both at about 20% here, and Generac has garnered about 60% of the vote. So we will put 3 positions of Generac into the portfolio.
Candace,
One
I'm
for
high-fiving
Mark,
you through
one
the screen.
for
Hey,
Candace,
Yeah.
and one for the audience. What,
I
Mark?
don't think we had a chance, Ken.
No, I don't think we did either. He was bound to determine. He even bracketed us, you know.
I know. I mean, he'll do anything to get the vote, okay?
In all seriousness, guys, those are 3 very interesting opportunities to study. I mean that sincerely.
Yep.
I mean, that's as, and probably I'm probably casting doom on all 3, but
oh, let's hope not.
let's hope not. Yeah.
And if you want to go to the next slide, Mark, I've closed the poll now.
Okay, and just a quick reminder, if you're not familiar, we do at YouTube, you just search on Manifest Investing and Roundtable, and you will find all of our archived presentations from our bull sessions, which are Tuesday afternoons at 2, and roundtables going back most of that 12 years, along with any of the other sessions like those successful investing COVID cancellation conferences. They're all there. And then we're also adding these little 60-second pieces down at the bottom. And I'd be surprised if Sean doesn't come up with some way of comparing Generac to Tesla or something in a future session. But he takes either a topic or a stock and just gives it a 60-second whirl. And it's going to be interesting to see how that kind of builds out. But we would greatly appreciate if you would subscribe to that YouTube channel. You just click that subscribe button. It will not inundate you with stuff, but you will be made aware anytime new content is added to the page, and that's going to help us get the message out to the world about investing. And
I'd like to personally thank Candace and Ann for both really, really good, solid presentations. We're getting a lot of comments from a lot of folks in the audience. Marie and Janet, for example, both would like to have another button tonight that says all of the above because they had a hard time making the decision. So here's Henry saying the same thing. He'd like to do that. Henry would also like to know, Mark, about the charging stations concept. So I'm going to look into that because my club is studying charging stations right now, and Generac has never come on our radar. So I'm going to look at that, but maybe you want to take a dive into that as well. Okay.
I will.
Okay. Let's see if I get some other questions here. Mark, any particular reason for the significant price drop in Generac recently, other than just the general market that you found?
I don't know. Candace might have some thoughts too. I think they're just running into a situation with supply chain disruptions and all kinds of stuff. I do know. Go ahead, Candace. Anything?
I was just going to say, I think that's all that I heard. I did see something about that any stock that was had any connection to the solar industry went down because of things closing down in China and maybe a shortage of solar panels. That may have had something to do with it.
Here's a comment from one of the guys in one of my investment clubs who says that Generac is back ordered for more than a year. It's going to be very difficult to get one of those generators because they're just sitting on back order right now.
Well,
They're very popular
Interesting.
here in Houston. On my street alone, I would think there is probably at least 3 or 4 houses have these, because when you're in hurricane country, they're nice to have. I personally would like to have one. I do have a question for Mark or Candace. I know some of my neighbors, I'm not sure if they have Generac or not, but when you buy these, you also end up buying a contract, I guess you would say, for these people to service this, because you can't just put them in. They have to be serviced kind of like your air conditioner or something like that. And I didn't know if y'all had come across anything like that. Is that just the individual companies doing that sell Generac, or is that part of Generac's deal?
I think that one slide did show that they did the servicing on them. So
was that in your slides, Candace?
yes.
Mark, I'm going to jump in because I have some knowledge in that area. My sister's significant other has a Generac, and he just had some issues with it, and he went to a couple of different people. He lives in New York, and he went to a couple of different people to get them to come out and service, and found out that the place that you call to get the service has to have a technician that's been certified by Generac to do the repairs. So it might be that they are training people to do these repairs, and that's where the income stream comes from.
Yeah, it would make
That may very well be.
Makes sense. Yeah, I could see that. I know that the place that we go to a couple weeks during the summertime up in Burt Lake, Michigan, has one, and we've used it probably 2 out of 5 years. So,
Did you check into their competitors? I know Kohler is a competitor.
Kohler is one of the higher ranking competitors, and there are a couple others. I did take a quick look, but they're currently at 75% market share, and obviously they're going to have to fight to maintain that. But they're certainly a respected company in that realm.
Well, and I had also read they have one of the largest distribution networks, and they've got really loyal dealers, all over. They've in pretty good shape.
Mark, we have a question from Lee. Could you go over the 3 things that make something a triple play real quickly?
I'll let Ann do it.
Okay, Ann.
I'll go ahead and go to Ann's slide, and she can take it through there.
Well, if you'll notice to the left that they're saying the annual return is anywhere from 13 to 21%, which will give you an indication that it has a depressed stock. And also, if you look on the graph, it's below the line, and that also shows you that it's a depressed stock. The second thing is P expansion. Right now, it's at 12.3. And they're saying, if I can read that, 18, I believe.
Yeah, it's 18.
It has potential to go to 18. And then the third thing is it has their net profit margin is showing that it's also going to expand. And that gives you your 3 triple plays.
Thank you so much, Ann. Pat is just telling us that he noticed that there was advertisement and representation in his local Costco store. I noticed the same thing in my local Costco store, so it looks like they might have a deal with Costco to sell these things together. Michael is telling us that Generac sometimes advertises free service for a year. if you're buying one, and that's one of their promotions that they're using to maintain their 75% market share. Barbara wants to know, does Western Alliance pay a dividend? A small dividend, Barbara, but not a significant one at the moment. And Michael wants to know, how did I find Western Alliance? Michael, I'm really a nut for looking at lists, and some of the financial magazines put out lists. I think it was Forbes puts out a list of the best banks in the country. And when I was looking for banks, I grabbed that list, and then I just went through real quickly SSGs in my SSG Plus of the top 25 or 30, looking for return on average assets that were exceptional. That was able to help me narrow that top 25 or 30 banks down to maybe 5 or 6. And then I could take a deeper dive into all of those. That's where I found First Financial as well, FFIN, another really, really high quality bank that you might want to look at. Another way to do it is to use your SSG Plus and go through the regional banks looking for up, straight, and parallel, and then pulling up the SSGs real quickly and looking for return on average assets. And again, you're looking for 1.5, 1.6 or better over a period of time. Scott is educating me that the categories that banks use are actually acronyms in industry categories, and they're used for regulatory filings. So that's why I was able to Google those abbreviations and actually find out what they said. Okay. I think I've gotten ourselves to a place where I've covered a large portion of our questions. I don't see anything new coming in. I'm checking for hands right now. Ann H has her hand up, and she's had her hand up for quite a while. Ann, I'm going to unmute you. And you are self-muted, Ann, so you'll have to unmute yourself. And oops, she took her hand down. That's what we call an inadvertent hand. The other hand that was up for a long time was our friend Ernie Felzani. Ernie, if you're there, I'm going to try to find you, or maybe you could raise your hand again and I will unmute you. Not having any great success here. Hold on a second. Okay, I don't see any hands in the air right now, and usually when I say that, 2 or 3 pop up. No hands have popped up at the moment, so we're going to call it a night. This has been fun, Candace. Ann, we'll put you both on our list and get you back here as quickly as we can. We hope to have Cy back with us again next month. We're always hoping to have Hugh with us. And so a big thank you to the Broad Assets. That's one club that I really admire. These folks, I think they're hiding one gentleman in the background back there, Mark. I think he's back in the shadows.
Yeah, we may have to get.
Yes, there is. Yeah.
but I see a tie back there, so yeah, I think that's a, But other than that,
I think he's sneaking into the Christmas party for some treats.
It could be. All right.
No,
so big thank yous to all 3 of you. Thank you to our audience. Thanks an awful lot to St. Louis. Folks, you in St. Louis were wonderful to work with. My wife doesn't give out compliments all the time, but she compliments you up and down one side and the other that you were so easy and so cooperative. And she likes to work with people like that. So maybe we try this again in a few months and see how it works. Mark, any last comments?
Oh, I'm happy, especially if the Cardinals continue to prosper.
All right. Okay. So with one last nod to the Cardinals, we wish you all good night and better investing. Thank you all.
Thank you.
So much.
Good night.
Thank you.